Hello, this is Bill Scheid from Applied Finance Research with an overview of the system performance of PMA SPY during the Great Depression. So what we have on the screen is a chart of the S&P 500 from 1929 to 1954. And before we look at the system performance, I think it's important to just look at the market to get a sense of the context of the time. The Great Depression is often thought of as the period from 1929 to 1933. However, we're going to expand our analysis and look at the period from 1929 to 1954 because the S&P 500 didn't get back to break even until 1954, spending an unbelievable 24 years and 11 months underwater, 1 month shy of 25 years. Now, of course, the actual S&P index in its current official form wasn't introduced until 1957, but there are a number of sources of compiled and aggregated data for historical approximations of the S&P 500 from before 1957. And the data that we're looking at here come from TradingView. Now, one of the first things on the chart that jumps out to me is the 1929 peak and the 25 years until the 1954 recovery. And the ride along the way to get back to break even was definitely brutal for anyone doing buy and hold. This first drop of 84% right here remains the largest drop in the history of the S&P 500. Then there was this drop of 25%, there was this drop of 45%, there was another drop of 40% here, and another one of 25%. In one of his books, Ray Dalio says that the common belief during this era wasn't what it is today. It's not, buy and hold for the long term, the market always bounces back. It's not timing the market, it's time in the market. No, Ray Dalio says that the common belief of that time was that the markets will break you. And I can see why looking at this chart. So the question is, how did PMA SPY perform during this period? What we have here is a backtest of PMA SPY generated by EdgeRater from January 1st, 1929 through December 31st, 1954. So from just before the crash of 1929 until just after the S&P broke even. On the chart, the blue line is the PMA SPY equity curve and the orange line is for the S&P 500. We can see that the system well outperformed the S&P and did it on a fraction of the drawdown. Looking at the metrics, we can see that the system returned 361.5% versus 44.7% for the S&P 500. The system had about half of the maximum drawdown of the S&P 500, coming in at minus 43.4% versus minus 84.2%. The CAGR for the system was 6.1% versus 1.4% for the S&P 500. I think that's interesting because these 25 years were some people's entire retirement. It would be really hard to retire on 1.4% CAGR, but 6.1% is spot on with the 6% target that's so popular in the world of retail investment advising and retirement planning. The next metric is return to drawdown ratio. I really like this metric because it's an excellent shorthand number for the risk to reward value add of a system. Everyone wants reward, no one wants risk. This system has a return to drawdown ratio that's roughly 16 times better than the S&P 500, coming in at 8.33 versus 0.53. So that is a huge value add for the system. And finally, we have the ending balance of a hypothetical account that starts at 100,000. The system has an ending balance of 461,507 versus 144,700 for S&P 500 buy and hold. Now, going back to the chart, what's interesting to note is that in the period leading up to each of the 5 major drops that the market experienced, the system was in cash as represented by the flat slope of the equity curve before those market troughs. So we can see here at the 84% drop, the market was the system was in cash as the market was going down. We see the same thing. The system was in cash as the market was heading into this trough, in cash as it was heading into this trough, and in cash as it was heading into these last two troughs as well. And that is exactly what the system is designed to do. So you can think of this system as a capital preservation trend following system. And why it really shines is because it's designed to avoid major drawdowns. As the saying goes, one of the best offenses is a good defense. Avoiding major drawdowns is one of the huge keys to long-term success as an investor or a trader. Financially, losses compound against you. If you lose 50%, it takes a 100% gain to get back to break even. If you don't have huge losses, then you protect the gains you made and you compound them when favorable market conditions return and the system rotates back in. And that is exactly what we see the system doing during this period, and that's why the system performs so well. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.